G'day everyone, welcome to this global update for markets around the world for the 5th of October. The title today, Changing Character of Markets, and we've certainly seen some volatility in the last week and some definite signs from some of the markets that the character of their trends is changing. So this is a very important video because it's I think it's a bit of a turning point in at least some markets, but not all. So let's have a look at the action last week. The American stocks, the S&P index was down about 40 points at one stage. It was quite a volatile week, but ended up rebounding strongly on Friday night and only ended up down 15 points on the week, which is pretty mild. So we are seeing increasing volatility. We saw the S&P do something that it hasn't done for quite some time, and that's break its 50-day moving average. And it also broke a short-term low. So we haven't seen that for a while. So just a couple of signs in the States that things might be just waning a little bit. But then on Friday, of course, when things looked a bit bleak, we got the all too common powerful rebound and closed up quite strongly, as you'll see when we look at the chart in a minute. Now, the fundamentals in America, particularly corporate America, you know, some of the economic data is positive and some of it is less than ideal, but corporate America is in pretty good shape. There has been a vicious sell-off in the energy sector since July, though, and oil has come off quite a bit, and the amount of oil being produced has meant that that's kept the pressure on prices. So it's still quite sector specific in America. So sector selection, absolutely vital. Now let's just have a look at the quick European indices, because this is where there are some changes or perhaps some changes occurring. We'll have a look at the German DAX, and clearly this index is rolling over now, as you'll see. So things are definitely changing in Europe, and the stock market rally that I expected to see because of the ECB money printing seems to have run out of steam, and in fact markets are rolling over. Now the FTSE also seems to be stalling a little bit. It's made maybe 10 attempts to break a resistance level, continues to be rejected by that level, and it's going to be really interesting to see how that one resolves itself. Still a bit of a question mark on the FTSE. So let's look at the S&P first of all. Now we'll pan right back, which is always the best thing to do. Take a good long-term look, and you can see that there is no change in character in America. Now you'll read lots of things that says that, you know, the market's starting to correct and there's weakness and all the rest of it, but in the S&P index, it's not the case. So we had a decline to the 150-day moving average, which is the red line, and we haven't seen that since February. We also broke this short-term low here, which was formed on the 15th of September, and we haven't seen anything like that for a little while as well. But at this stage, with a solid reversal on Thursday, and as you can see, a very strong session on Friday, the American market, at least the S&P anyway, is just continuing on as per normal. Now looking internally, let's have a look at the Russell 2000. Now this is important, and this is what some people are talking about. The Russell 2000 is looking like it's running out of steam, and that is true. The Russell 2000 is underperforming the S&P index. There's no question. So the smaller end of the stock market is struggling a little bit, and quite a number of sectors are actually down on the year now. However, there are certain selected sectors that I keep banging on about all the time that are still doing very well. So you don't want to just tar everything with the same brush. So at this stage, you can see the Russell 2000 has got down to important support. It was a support level in November of last year, again in February, and again throughout May. So this is a pretty important level. The index is oversold, and it gapped up on Friday. So the big question here with the Russell is whether this continues to follow through to the upside. Now, one thing that you will notice is that the the moving average, the 150-day moving average, which on this chart is shown in purple, has flatlined now. And the price is spending a lot more time below that moving average. So there's definitely been a change in character in the Russell 2000 over the last, let's say, since April, so over the last 6 months. But the question is this just going to be a lengthy sideways band of trading, or is this a topping pattern and we're actually going to go into a phase 4 decline? We don't know the answer to that yet, and we probably won't know the answer to that for a couple of months. But hence, it's really important to stay with the sectors that have still got momentum. Now, let's take a look at the DAX, because this is the one that I think clearly now is rolling over as a major index. So this is the top 40 stocks in Germany. You can see we had an extremely powerful rally, which is now basically petered out. The moving average is now heading sideways. So this is looking very much like the Russell 2000. But remember, this is the top 40 stocks or top 30 stocks in Germany. No, I think it is the top 40 stocks. So we're really seeing weakness at the high end of the market, not the small cap end of the market. So I think definitely a change in character and a change in trend in the DAX. Let's look at the UK FTSE index. Now, if we shuffle back, you can see there's been numerous attempts to break this level around 6,800 to 6,900. Started back in July of 2007. We had a couple of goes at it and then it failed. We went into the GFC. But since then, since we've recovered again, you can see there's been, well, there's almost too many to count here. There's nearly a dozen touches of this level and it hasn't been able to break through. So all we can say at the moment is that the FTSE is really in a big sideways band. Again, is this a topping pattern that'll lead into a phase 4 decline, or is this just a big sideways consolidation? We don't know yet, but it means that you shouldn't be trading these markets with the same level of confidence and the same processes that you did before. Now let's look at the Aussie index. The Aussie index ended up rising by 5 points on the week. That was largely because of some catch-up on Monday from the previous week. But look, I think I can say with a reasonable amount of confidence that the phase 2 bull market in Australia is finished. It's done. It's over. The banks are now trading behind where they were 12 months ago. And I think not a lot of people are recognising that. A lot of people have memory for the last 6 months when the banks have been delivering good profits and the share prices have been going up. But if you look over the last 12 months, bank prices, as we'll see when we look at the index, are exactly the same level, or in fact a little bit behind where they were a year ago. And compared to a year ago, they've got numerous fundamental and valuation headwinds. There are all sorts of things that are against the banks. Now, I'm not saying the banks are in trouble, not by any stretch of the imagination, but I think it's going to be extremely difficult for the banks to maintain their profit growth and therefore their dividend growth. So why would you pay historically high valuations when the environment is getting tougher? So I think the banks have got some significant downside in price. So again, let me repeat, I'm not saying the banks are in trouble, because a lot of people love the banks and they don't want to hear that the share prices of the banks are coming off. But you've just got to be realistic. It's just not realistic for the prices to stay at historical valuation highs based on all sorts of different metrics when there are so many things that are going to be putting a restriction on profits. Again, is this a broad sideways market, or is it leading to something worse? We really don't know. We've seen an incredible burst of overseas selling in the last few weeks as the Australian dollar fell apart. And that's a big unknown. We just don't know how much more selling from overseas is out there. So it's very hard to know where the Australian index is going. Now, we've had a minor break of key support, but I would expect that we'll probably have a reasonable day on Monday. If we don't, then you know that our market is in all sorts of trouble. So that will be an indicator. Now, the key level, as we'll see on the chart in a minute, is 5050. But frankly, if the market gets down to that level, if the index gets down to that level and you haven't done anything about winding back your exposure, then the damage to your portfolio has already been done. So, don't use 50-50 as a level where you should take some action. You need to be taking some action right now, or actually a week or so ago, as members would know. Now, this analysis that I'm going to show you in a minute is not about when to get out. It's about how to make money in the next phase of the market. Are we going to have an extended sideways market, or are we going to go into a phase 4 decline? So this analysis is very much about what comes next. So let's take a look at the Australian indices. So we'll start with the ASX 200 first of all. Now you can see that I've marked here two big broad bands in green, and they represent some key support levels using Fibonacci analysis and just using some garden variety support and resistance levels. So two key levels. You can see we just had a dip under the first of those key levels in the start of this week. We got a strong rebound on Wednesday. We'll probably get a little bit more follow through on Monday, and you would want to see this index get back up to 54.11 or even 54.62. I think that would be my preference, 54.62. If we can get to that level, then you'd say the market is showing a reasonable degree of strength and therefore is likely to continue into a sideways pattern. But if it doesn't do that and it breaks this level around the 52.80 area, then you're looking at significantly larger declines. Now, if you have a look at the last couple of times that the Australian index broke the 150-day moving average, the red line, you can see we had one here in June of 2013, and it spent about 3 weeks under the moving average, but at that stage the moving average was still rising. We had another event here in December, and it was just a handful of days, not much more than a week. Again in February, about 10 days, but very, very quickly back above the moving average, and the moving average didn't ever flatten out. You look at where we are now, however, the moving average has flattened out, and we've now been below that moving average for an extended period of time. And that's why I think it's important, if this market is not going to go into some sort of phase 4 decline, that we get back above 54.50 pretty quickly. So they're the key levels for the ASX 200. Now let's just look at the materials index, and then we'll look at the finance index. So this is the materials index, clearly in trouble. You'd have to say it's in a big picture downtrend, medium term sideways, and short term it started to fall again, and it's broken through all these recent lows. So not a good sign at all for the materials index. So that's BHP, Rio, etc. Now let's look at the finance index. Finance index, the same patterns. We've seen the moving average heading up very strongly, the price virtually never below it. We had a little excursion here in January, lasted about 2.5, 3 weeks. But now we're starting to see that moving average, because we've been in a sideways band now for some time, that moving average is now flattened out and we're back underneath it again. Now let's just take a look at where we were 12 months ago. So 12 months ago takes us back to October. There we are, around about, so we're around about here. So that's where we were 12 months ago, at about 5,800, and you can see we're only marginally above that level after 12 months. So yes, you've had a dividend return from the banks, but you've made virtually no capital gain, and as I indicated to you before, we've now got all these lows through here, 1, 2, 3, 4. All those lows have now been broken. And fundamentally, the banks are, I believe, are extremely expensive compared to the headwinds that they're facing. So just exercise extreme caution in the Australian market. Let's look at commodities. Gold has been absolutely smacked, down $27 for the week. Look, I'm fundamentally a bull based on the real supply and demand situation. And I don't think anything very much has changed in that regard. And it's the US dollar strength that's doing all the damage to gold at this stage. Gold is sitting right on absolutely vital support. If that breaks, the gold market is going to experience some significant selling. But offsetting that is the fact that below $1,200 an ounce, it's not going to take too long and you're going to see gold mines close. And of course that reduces supply and that changes the equation and puts some stability into the price. So there's no need to be completely doom and gloom on gold, but certainly as you'll see from the chart, we're really at a key point. Now, silver, not showing any signs of recovery, just leave it alone. There's a few commentators out there calling to buy silver, don't touch it. Copper, slightly lower to $3.03, but still holding reasonably well, but crude oil is down to 89, and that's really what's causing the problems in the energy stock market. Let's just take a look at gold. So this is gold on a weekly chart. So you can see we had the meteoric rise up to 1900. We've then had a big decline. Haven't quite got down to the 61.8% level, but not far off it. And you can see we've had this declining wedge, which is not a good pattern. At one stage, it looked like we had an uptrend within that overall phase one base, but gee, we're perilously close to breaking this wedge. And if we get down around the 1170 mark, I think you're going to see a wave of selling come into the gold market, and you're going to see gold stocks get smashed. So just be very, very careful about your exposure to gold stocks at this point in time. This is an absolutely critical level. If you look at silver on a daily chart, you can see we had a key support level here at about $18 or $19. It's been absolutely smashed, and we're down now in the 16s. Trying to buy into silver at the moment is like trying to catch a falling knife. It's just something you don't want to do. This is the spot copper chart. Just wrapping up now. You can see we're still in this big picture trading band above $3, which is still reasonably profitable for the better copper producers. And this is the nickel price, which has been sliding from $9 down to $7.50 in the last month or so. So overall, the strategy approach, you want to be very, very cautious on Australia because we just can't gauge the extent of the overseas selling. I don't believe the amount of money involved, I don't believe it can be anywhere near finished. So therefore, if you're going to buy in Australia, and it's not to say there aren't good stocks and there aren't going to be good valuations becoming available, you need to be a lot more demanding on the entries. Selected sectors will remain profitable, particularly in America, especially in America, but only if you buy great fundamentals, if you buy sound value, and you buy the dips. So process is still important. Now, I've covered an awful lot in this video. I think there was a lot of important things to talk about. If you want to discover more, these turning points in the market are where you really make your money and you can protect your capital. So if you want to understand more about how to do that, there's an information webinar, which is Tuesday night, the 7th of October. Now, for members, there won't be anything new here that you haven't seen, but this is really for non-members of Specialist Share Education. Now, if you would like to be invited to attend the webinar, just drop me an email on the email address on the next slide. So next Tuesday, I'll be going into a lot more detail. You'll be able to ask questions as well. And I'll be covering specifically how you go about finding the best opportunities around the world, what the most reliable trade setup is out there, and also going to give a few examples of some stocks that are poised for big picture moves. So more information about what we do on our website there, and there's my email address if anyone wants to contact me about anything to do with trading, and if you would like to receive an invite to the webinar next Tuesday night, please do so. That's it for this week. Cheers.